HSBC TV 18, celebrating 15 years of leadership.
We do not intervene to try and target a particular level for the exchange rate. Where we do intervene is to reduce volatility.
Looking at another 75 basis points of rate cut in this cycle is good enough.
Rate cut expectations do stand. There is asymmetrical transmission whenever there is excess liquidity.
We think that between 1.5% to 2% is a reasonable real rate.
It's Raghuram Raj's birthday today, but no party on the Lal Street and Main Street as rates remain unchanged. Good evening and thanks for joining us here on India Business Hour. Here are the other headlines that we're tracking tonight. No surprises from the RBI as Governor Rajan sticks to the script, leaves repo rate unchanged but nudges banks to cut rates with a 50 basis point cut to the SLR. RBI says inflation and the upcoming budget will determine future moves. RBI empowers banks in the fight against bank loans. Banks get flexibility to mark loans given to stressed companies as non-performing assets provided a new management takes charge. RBI changes policy stance as a U-turn in order to encourage FDI, will allow foreign investors downside protection on India investments via put and call options, links assured returns to sovereign yields. CNBC TV 18 told you about this first on the 13th of January. Bank stocks tank after RBI's policy and poor earnings from the Punjab National Bank. Bank Nifty plummets nearly 500 points. Sensex clings on to 29,000 after losing over 120 points. The petrol prices and diesel prices cut by over 2 rupees a litre. This is the 10th straight cut on petrol and 6th consecutive cut on diesel prices. The government moves to iron out the subsidy sharing formula and fast-track perhaps the ONGC divestment. Sources say the oil ministry asked the government not to impose any subsidy burden on upstream companies if crude prices stay at or less than $60 a barrel. That's an exclusive. Coal block auction set to see some aggressive bidding. The government receives 176 technical bids for 21 coal blocks. This after the Delhi High Court allowed the auction to proceed with riders while hearing a petition from GVK Power. The country's largest two-wheeler maker Hero MotoCorp misses estimates with its third quarter numbers. Profits rise 11%, but weak sales coupled with tepid margins drag revenues lower. Vodafone's top brass meets Telecom Minister Ravi Shankar Prasad. Group CEO Vittorio Calao says they are not against listing their India business and are waiting for the right time. A fight to the finish in Delhi as sparks continue to fly. Prime Minister tears into the Aam Aadmi Party over charges of dubious donations, but the BJP makes a faux pas in its vision document terms people from Northeast as immigrants. And straight to our top story this evening, the RBI did not cut rates in the policy, nor was it expected after the out-of-turn rate cut it gave just 2 weeks back. However, in a bid to prod banks to pass on that previous cut, the RBI did reduce the SLR, or the percentage of their deposit that banks have to invest in government bonds. Here are the highlights of that credit policy.
Given there has been no significant new development on inflation and the fiscal front since then, we have maintained status quo on interest rates.
That was the terse message of the RBI governor's policy today. What will be the next action and when?
Further action will be in the direction that was initiated, and that it will depend on developments, in particular on developments on the fiscal front, as well as a continuation of the disinflationary process.
To be fair, the governor has too many moving parts to announce any further action. Again, as he put it.
What we have said is we're waiting for data. We have a budget coming up. That's a significant change in the fiscal space. It is going to be an important change. We've got new GDP numbers coming on February 9th, which will reflect a whole new view of what's happening in the economy. We've got inflation numbers coming. I mean, this is all data that we need to watch for. Now, if I cut interest rates today, again, 2 weeks from now, you'll be asking me, when are you cutting rates again? So let the monetary policy process follow its due course. And monetary policy, remember, works with long and variable lags. In India, approximately 3 quarters.
Most market men are interpreting this to mean that the Reserve Bank will cut after the budget, though the governor left one guessing on whether he will cut at the next scheduled policy meet on April 7th or whether he will once again give an intermeeting cut. The more relevant question, however, is how many cuts more. That depends on where the governor wants real rates. That is the difference between the repo rate and CPI.
I've said before that we think that between 1.5% to 2% is a reasonable real rate given where we are in the business cycle. Now, of course, different people have different views.
If Governor Rajan wants savers to get a real return of 1.5%, he can cut only if CPI goes sustainably below 6%. For a governor who cut rates in a hurry just 15 days before the scheduled policy, this policy cannot really be considered dovish. In the first place, the governor has not reduced the inflation forecast for January 2016. It remains at 6%. Also, he insists that the real rate, that is the difference between the CPI and the policy rate, should be at least 1.5 to 2 percentage points. With a CPI at 6%, that doesn't give much scope for rate cuts, maybe 1 or 2 more cuts at best. This policy is really to be remembered more for the steps it takes to deepen the debt market as well as to empower banks to handle NPLs. Also, it shows the Reserve Bank's ingenious attempts to ensure that foreign flows are not too heavy to make the Indian rupee uncompetitive. In Mumbai, with Manasvi Gelani and Ritu Singh, I'm Lata Venkatesh.
All right, Lata, thanks very much. That was, of course, the highlights of the credit policy. And as we've been pointing out, and that is what our poll had showed up as well, that it was expected to be a status quo policy. Now, the Reserve Bank's cautious stance and poor earnings rocked bank stocks today on the Lal Street. The Bank Nifty down about 500 points, and that dragged the frontline indices lower as well. The Sensex down 120 points in a very volatile session, slipping below the 29,000 mark, but it managed to close right at that level. The Nifty lost about 50 points, led mostly by banks and financials. Mid-caps underperforming the blue chips, with the index losing nearly 1% today. So that was the action as far as the markets were concerned. And on to Mint Street, where the rupee has strengthened further to end the day at 61.67 to the dollar. But we're not done just yet. We have to do a quick check as far as crude oil prices are concerned, because remember, crude prices have been rallying through the day today. BP has announced that it will scale down its expansion plans, and this has pushed prices higher. Both Brent and NYMEX are now higher by about 2%. In fact, Brent testing the $57 mark, but it has pared some of its gains for now. But Nantara, there's good news for consumers tonight.
And Shireen, better late than never. This should have come on the 1st of February, but it has now been announced. The oil marketing companies cutting petrol prices by 2 rupee 42 paise a litre. Diesel will cost cheaper by 2 rupee 25 paise a litre. This is the 10th straight reduction in petrol since August and 6th in diesel since the month of October. We should point out that the oil marketing companies have refrained from passing on the entire benefit to consumers. They've in fact retained almost 50% of the profits they incurred in the last fortnight on both petrol and diesel to offset what they call our losses against crude inventories. That's the latest as far as good news for consumers go when we talk about their budget.
But we're not done with oil and gas, Nantara. Let's talk about our big CNBC TV 18 exclusive story. Close on the heels of the quarterly results of oil companies and a possible 5% disinvestment in ONGC, the Oil Ministry has proposed a new subsidy sharing proposal with the Finance Minister. Nantara, we've been waiting for this new subsidy sharing mechanism for months now, and maybe because of where crude is and because of the many SOSs that ONGC has sent and the fact that the government wants to meet its disinvestment target and hence wants to push through ONGC, or at least one of the other companies from the oil and gas pack, it is now looking seriously at putting a new subsidy sharing mechanism in place. What are the details? What happens to the subsidy burden for the likes of ONGC?
That's right, Shirin. The timing is of the essence. We've seen a slew of meetings that have taken place between the Petroleum Minister Dharmendra Pradhan and the Finance Minister Arun Jaitley, and you've got to wonder why is it that as recently as last week, it is that the Oil Ministry has sent this new subsidy sharing formula to the Finance Minister. Now, this is what I'm understanding from my sources. What the Oil Minister has suggested is that if crude prices are at or below $60 a barrel, upstream companies ONGC and Oil India should contribute nothing towards the subsidy burden. If crude prices are between $60 and $100 a barrel, the contribution should be at 85% and 90% if crude prices are above $100 a barrel. And the fact that we've seen a slew of meetings and then this proposal has gone into North Block, I do believe that perhaps the final subsidy sharing mechanism is going to be along these lines. Now, what I also understand from my sources is that along with this proposal, what the Oil Ministry has sent is its final batch of supplementary demands for the fiscal year 15, the current fiscal that is. It has calculated the under-recoveries on the basis of this formula that I just spoke about. It is pegging the under-recovery bill in FY15 at 77,594. You subtract the 31,926 crore rupees that the upstream companies have already paid in the first half. Then you also subtract the 17,000 crore rupees that the government has already contributed in the first half, and you're left with a figure of 5,078 crore rupees as the upstream contribution for the second half of this fiscal, and this is crucial. ONGC and Oil India may have to contribute only 5,078 crore rupees for the second half of this fiscal. What I also understand from my sources is that Dharmendra Pradhan has sought an additional grant of 18,254 crore rupees from Arun Jaitley. So are we going to see that in budget 2015 or not? It's quite small if you think about all that he's lapped up from the excise duty hikes.
All right. Well, he has many holes to plug at this point in time, Nentara. So 18,000 crores is not something to scoff at, but watch out for ONGC. That is going to be a stock that we will be checking on in trade tomorrow. Now, the credit policy today announced some revolutionary steps to give bankers the power over their defaulting borrowers. Loans given to stressed companies will not be marked as NPLs, and they will be allowed 2 years of delay in the commencement of their projects, provided new management replaces the non-performing old one. RBI is also looking to waive pricing restrictions when banks convert loans given to stressed companies into equity. Manasvi Gilani gets you more.
In case there is a new promoter, distinctly new promoter brought in, not part of the same group, but somebody new, then banks could get some more time to complete the project with a new promoter. That will put some of these projects which are stuck back on their feet.
That's a big breather coming in for the banks. The birthday boy may not have treated banks with a cut in key policy rates today, but Governor Rajan has got a thumbs up from bankers for allowing them to tackle loans that are at the brink of turning bad more flexibly. The RBI basically said that if the date of commencement of a stalled project is pushed back by 2 years because it is being taken over by a new promoter, then banks won't have to mark the loan as substandard. Under current rules, a project that doesn't start on time has to be marked down as a bad loan. Bankers say the change in rules is exactly what they have been asking.
It is a very big enabler. The banks have also been asking RBI to give this dispensation, mainly because when a good promoter is coming forward to take over a stressed asset, that promoter doesn't want a NPA status account in their books, and they're quite resistant to that idea. So if this is no longer going to be called an NPA, it does give an incentive to the new promoter to come forward and take it over. So definitely this is something which is a big enabler, and we are very grateful that RBI has considered it. But yes, it will ease our job in trying and getting new people.
The other big step that RBI is taking to help restructure loans is easier conversion of loans into equity. RBI is consulting with market watchdog SEBI for a waiver of the current pricing rules under the takeover code, as these rules allow the conversion only at a higher share price.
Doing it at the SEBI formula currently can be very difficult for banks, because what happens is from the next day itself, the banks have to take hits on the mark-to-market on that particular equity. So it is very important to have a differential pricing formula, and again, we are very glad that the regulators are considering it. Should the differential pricing come about, it will again be something that will strengthen the arms of the lenders.
It is hoped that these rules will make banks proactive in acquiring control of companies run by bad promoters. In Mumbai, Manasvi Gilani.
Today's credit policy did its bit to stem the strengthening of the Indian rupee. It's also allowed Indians to spend more dollars. It subtly slowed the flow of foreign funds into Indian debt, and it's also ensured that these flows don't flee the country when the Fed hikes rates. Lata and Ritu Singh explained the RBI's moves on this front.
We have to be a little careful in this world. As I've said in past meetings, people keep looking at the exchange rate vis-a-vis the dollar and say our currency is weak, but we have strengthened versus virtually every other currency. So it is something that we have to be watchful for.
In fact, the rupee appreciated by 1.4% versus the dollar in 2014, whereas all other currencies depreciated versus the greenback. This can make Indian exports uncompetitive, and the RBI today took 2 steps to slow down rupee appreciation. One, it allowed Indians to spend more money abroad, upping the limit from $125,000 to $250,000. And second, it said foreign funds can buy corporate bonds only of over 3 years maturity.
There's too much sitting at the short end, and we would like to nudge people into the longer end. So we've said when you reinvest in 3 years and above securities.
The governor's move was meant to protect India from quick outflows when the Fed hikes interest rates. Short-term bonds tend to leave quickly and expose the economy and the currency to sudden shocks. Simultaneously, the governor also made it easier for foreign direct investments to come into India by tackling the tricky issue of equities coming with call options.
Let me emphasize, we are open to foreign investors. We welcome them, which is one reason the FDI action we have taken today, that is these put-call options that were embedded in various investments, we've said we're not against them. We just want to make sure it's not hidden debt.
Foreign fund investments in Indian government bonds has already hit the limit of $30 billion. For these funds, the governor had a small incentive. They can reinvest their coupon earnings even if it means crossing the 30 billion limit. And that's a small price to pay to retain the tag of a liberal central bank. In Mumbai with Lata Venkatesh, Ritu Singh.
And taking that forward, it is official, the Reserve Bank has changed its policy as far as put and call options are concerned. For more, let's go across to Menka Doshi. She joins us with the fine print. Menka, we had talked about this in the connection of the Tata Docomo proposal to the RBI on the 13th of January. And it seems like the RBI has now decided to change its position on put and call option pricing.
Absolutely, Shireen. This is a 180-degree turn in RBI's position, a long-held position that any equity investment that comes with assured returns is akin to debt and therefore is not permitted when it comes to agreements with foreign investors. Over the years, RBI has, to be fair, liberalized that position a wee bit. So at one point, they linked the pricing of call and put options after permitting them to return on equity. Then finally, they said they can be priced at, fair market mechanisms available anywhere else in the world. So call and put options, which were earlier not permitted, have over the last 2 years been permitted, but with no assured returns. Now the RBI is speaking a whole different language. As you pointed out, this language was first used in its response to the Tata Docomo petition, which asked whether Tata could pay Docomo an assured price of sorts, and RBI said yes. And now it's been made official in the monetary policy statement, where the RBI has said that in order to encourage FDI and to introduce greater flexibility in the pricing of both such instruments as well as securities used to allow FDI into the country, the RBI will allow assured return at appropriate discount over the sovereign yield curve through embedded optionality clauses or in any other manner. Before I go any further, Shireen, let's listen in to what the governor had to say specifically in this regard today.
That is, these put-call options that were embedded in various investments, we've said we're not against them. We just want to make sure it's not hidden debt. So if you have a put option, but the put option is at a price which is lower than what you invested, so you don't get a guaranteed debt return, we're okay with that. So we're trying to make it easier for foreign direct investment. There are other features that were earlier not favored, which we will open up as we look into this and come out with a detailed paper. But the idea is to make it easier for foreign direct investment, even with a variety of contractual features that would allow these investors to put money in.
Now, Shireen, typically foreign investors use put options in order to exit their India investment if they haven't got an exit through any other route, let's say i.e. an IPO. Because they were not permitted so far, and then when permitted with great restrictions, there were a bunch of disputes on this, as you've already noticed in the Tata Docomo case. What the RBI now seems to be saying in its monetary policy statement is one thing. What the governor seems to be suggesting is another thing. So what you just heard the governor seem to talk about is capital preservation, saying if a foreign investor wants to be able to take back some or all of his initial capital, we should be able to permit it. Whereas the monetary policy statement uses words such as an assured return at an appropriate discount over the sovereign yield curve. So that's a return over and above capital preservation. So it's curious exactly what the RBI intends to permit here on. They've said they will issue guidelines, and I know industry will be watching very closely to see what they finally decide on. But this is a big change in position at the RBI. It is good news for foreign direct investors, but I'm sure many Indian promoters are going to be grumbling at this because they will now have to cough up what they've promised their foreign investors. That is, of course, if these new this new position comes with a retroactive clause. That is, will it apply to previous agreements or will it only apply to agreements from here on? So lots of details that yet need clarity, and the guidelines hopefully will give that to us.
All right, Menka, we'll check in with you for more clarity on the guidelines as and when we do hear from the Reserve Bank. But thanks very much for joining us, Menka, there, taking us through the fine print of what the monetary policy has to say as far as put and call options are concerned. As we've been pointing out in the story we've been reporting on, there is a change of stance at the RBI. On to earnings now. PNB reported a weak set of third quarter numbers, and that was on the back of worsening asset quality. Net interest income flat at 4,233 crore rupees. Profit grew by only 2.5% versus an estimated growth of 23% quarter-on-quarter. Bad loans spiked with gross NPAs nearing the 6% mark and the net NPA ratio at the 4% mark. Gauri Shankar, the executive director of the bank, has mentioned that pressure on asset quality will continue for the next 2 quarters. The stock taking a hammering down 8% today.
Wherever it is possible, the NPAs, the moment they slip, in the next quarter, the recovery has to be better. So what we anticipate that the recovery is going to be better, but let me tell you, the stress on various accounts still remains. And if you ask me about any kind of a guidance for the next quarter and next to next quarter, my reply will be that the next 2 quarters are going to feel same kind of a pinch. But definitely, our emphasis on recovery and not letting the assets slip down to the NPA level are going to give us good results.
And the PNB stock down nearly 8% in trade. Another counter to come out with a disappointing set of numbers was Hero MotoCorp. The two-wheeler major clocked profit growth of 11%, meeting street estimates, while net revenue fell marginally to 6,839 crores. Hero saw a massive 8.5% drop in EBITDA, and operating margin also fell from over 13% to 12%. So a tough quarter for Hero MotoCorp.
And that stock will react to those numbers because, remember, the markets had shut for the day when the results were out. Coal blocks are set to see some fierce bidding. Technical bidding for 23 blocks drew to a close today. The coal secretary says 21 blocks have seen 176 technical bids. Blocks with less than 3 technical bids will be put up for the next round. The e-auction will begin on the 14th of February. And staying with coal, the government appears to have weathered GVK's challenge to the coal auctions for now, with the deadline for submitting technical bids expiring today. The Delhi High Court has allowed the auctions to proceed, but with the caveat that it will be subject to further court orders. Ashmit joins us now for more details. Relief for the government, Ashmit, because the court has not given a stay.
Interestingly, yes, it is a relief coming in for the government weathering that small storm. But of course, the caveat has to also be kept in mind. The Delhi High Court holding that these auctions are allowed to proceed, but subject to further court orders. Now, importantly, GVK had moved the Delhi High Court with respect to the quantum of compensation. That was the issue, and it assumed significance given that the deadline for submitting those technical bids expired today. Now, GVK, represented by none other than the former Finance Minister P. Chidambaram, now wearing the hat of a lawyer, raised the argument that the compensation that they had sought was 350 crores. The government had provided only 57. But the second and the more important question that they had raised from the perspective of a bidder was that the government, by way of a circular, had provided that in the event that the compensation amount due to the prior allotee, it sees an increase due to litigation, then that additional amount will also have to be borne by the successful bidder. GVK argued that this muddies the water. There is no clarity with respect to the capital cost involved, and hence that reflects as a part of confusion over what the final bid should be as a part of the technical bids that were required today. For now, the Delhi High Court has given the green signal, but of course that caveat that it will be subject to further court orders. It's also important to point out that various other stakeholders, various other bidders are also watching this case very carefully from the sidelines. So clearly this is one plea that could have a spillover effect onto other various bidders. So clearly awaiting more cues, and we can expect that on 23rd when we see further hearing. Back to you.
All right, Ashmit, thanks very much for joining us with those details. On that note, it is time for us to wrap up this edition of India Business Hour. Tomorrow promises to be another exciting day. Do remember to tune in to a CNBC TV 18 exclusive interview with the Chief Minister of Maharashtra through the day tomorrow. From all of us here, good night. Thanks for watching.